First of all, thank you to VentureCrowd team for organizing this event and allowing us to participate. It's been amazing. I want to start off with not disclosure, but how about quick question? Okay, we're going to read through. I just want to get a show of hands for who believe that AI will truly change the economy over the next decade. Now, kick your hands up if you are meaningfully invested in AI, whether it's in the infrastructure layer or at the early stages. Now, put them down. Your AI exposure is only through the public markets, whether it's through the magnificent. I think that is the gap that we identified today. Because the halfway for conviction to allocation is actually filled with uncertainty and noise. And, for us, from sort of, during this period of time, what we see is that a lot of investors actually choose not to invest because they want to avoid risk or they want to reduce risk. And in return, what are they doing is actually giving up an opportunity to deliver asymmetric returns by having conviction when other people are hesitating. But even when people are actually choosing to invest at this period of time, the challenges that they face is accessibility to investment opportunities. Because the most transformative AI company is not actually built in plain sight. It's actually behind the scenes in a private company. And as private company stays private for longer, by the time they actually get public, most of that value is actually already being captured. So for those that haven't met me tonight, my name is Derek Chan. I'm one of the founding partners of All Ventures, which is the dedicated venture capital arm of the All Group. Actually also one of the co-founders of All Group, which is now a $1.4 billion alternative asset management platform. We've been in operations for over 17 years. And one of our missions is actually to enable managers such as myself to be able to execute on specialized strategies without compromise between performance for scale. And if you want to do a deeper dive just to what I meant by that, you can grab your later. We can chat about it. But as a venture capital investor, I guess my job is really to distill the signal from the noise, right? And what that means in practice is actually, I spend the majority of my time actually trying to assess the risk of where the mispricing is happening and identifying where there's a potential structure change that's going to occur that's going to deliver asymmetric upside. And hopefully today, I'll be able to talk you through one of those moments that's happening right now. So I think through that is excited before, it's kind of pretty obvious that we all believe that AI is no longer a concept. It is in fact a economic force that is driving or reshaping the way we think about productivity, creativity, and even human interactions. And AI is not just a technology cycle, but in fact, it is a platform shift, or as we describe it, as a platform shift. And what that means is an innovation that is so great, so powerful, so strong, that is actually changing and rewiring the way the world operates. Similar to the way mainframe happened, internet and mobile, etc. And we're early in this cycle. And at the early stages of this cycle is when we often find the most valuable entry points. And the latest example of this is actually in SaaS, as you guys might know. If you're going to look at this chart, what happened was, in the early days of SaaS, is you saw valuation very stable, right? It was very flat. And it was during a period where there was a lot of non-believers, where people didn't really understand why these type of businesses deserve venture multiples. They didn't really appreciate the value of the recurring revenue nature of these businesses and the ability to generate network effects. But soon they realized that these were not just traditional businesses, but in fact, they were compounding machines. such that they were able to deliver hyperscale growth. And as these models started to get proven and adoption started occurring, then valuations re-rate, and then they until they peak. But what's really interesting that's happened is that not only are we going through a technological platform shift, but we're going through a quick conversion of that shift with a reset in the market that happened in 2021. So, as we studied the previous vintages of funds globally, what we've realized was that actually many of these funds that were raised from immediately after a downturn or what we call a moment of disbelief actually performed better than most other vintages. And our belief is that if history right, then the next vintages that's coming up in the next few years is going to most likely perform better than future ones. And that is why we believe that venture capital is so important right now, because we are in that moment of time where we're early in the cycle. And what happens is because in VC, you're investing early, right? You're owning equity before institutional saturation. You're often participating in a 5 to 10 year value creation, but you gain that exposure to the structured technology shift. So we've been investing in venture capital since 2013. And this was during a period where the market was basically non-existent, right? So we had the opportunity to basically rope the market and help shape this market. And over this 13-year plus period, we've had the fortunate, we have been fortunate enough to basically raise and deploy 3 funds going into our pool. But every dollar that we invested, every dollar that we've raised, every win that we've had, every loss that we've made, is basically just data for us that goes back into feeds back into a learning cycle that has allowed us to reiterate and change and sharpen the way that we actually invest. And historically, we've managed to, through the previous vintages, to deliver a 3 times multiple in invested capital, whilst returning actually more than 85% of invested capital that we have raised, that we have deployed today. But if you zoom in just in the latest vintage of our funds, which is our 2022 vintage, you'll see that we've actually just reached or hit our top quartile returns compared to US benchmarks. And we do this by backing category-defining businesses of really, really early. All right, these are 2 examples, and I chose these 2 examples deliberately because Catapult is one of the first investments that we've ever made back in 2013, and Haas is one of our later ones for 2.5 years ago. For those that don't know, Catapult is basically a wearable. They basically capture data from wearable devices, but then goes through their SaaS platform to create intelligence for coaches to reduce injuries, to reduce players' injury and improve efficiencies of their displays. When we first invested in that company in 2013, the business was a $10 million business. We were one of the first seed investors in that business. And from there, they're now growing into a global leader, hundreds of millions of recurring revenue, and listed on the ASX with a market cap of over $1 billion. Whereas Haas, it's actually one of our more recent investments in the AI application layer thesis. And Haas is an AI compliance business, which basically automates 80 to 100% of manual compliance. And over the 2.5 years that we've invested, they've now grown and expanded outside of Australia into the US. They raised the most recent round, their Series A in the US, which has driven our first investment to as a 12x uplift. But they've also now count some of the largest enterprises in the world as customers, including guys like Zurich or AI. And I believe that all the outputs that we've had today, it's basically linked to the approach that we've actually reiterated over time. And the way we invest is basically we have been deliberate in investing into a specific stage, being C. And we chose C because we believe it's the most underserved, inefficient part for market. And by focusing on a single stage has also allowed us to basically compound our muscle and compound that experience in that particular segment. But we've also learned to play the field. And what I mean by that is the realization that being an Australian VC investor is very different to being an investor in any other region, such as the US. And that includes things like having to be price disciplined in a way that you don't have to in the US. It also includes being having ownership preservation mindset. The other thing that we've done is actually lean into the valuation arbitrage that happens between Australia and other regions like the US. So to give you an example, if you look at a median seed stage valuation, it's about 40% cheaper in Australia than the US, purely because that company is in Australia. And the way that we help our portfolio companies is actually a system in actually expanding into other regions. But of course, being an early stage investor, there's obviously a high level of risk. And the way we de-risk our investment is taking an approach of being a high conviction investor. And we become thoughtful in the way that we actually construct our portfolio so that we're not over diversified. And by being a high conviction investor, it means that we actually run more concentrated portfolios, allowing us to have the capacity to add value to our founders in our portfolio companies, and hopefully improve the probability of success. And lastly, we have been deliberate in being an industry and sector agnostic firm, purely because we understand the size of the Australian market does not allow necessarily for you to be niche or specific. But also, more importantly, we believe that technology comes inside. And because of our region, we actually have a very, strong institutional DNA as part of Dover. And through that, it's allowed us to basically overlap our institutional rigor in both processes and governance, but still overlap that with a very entrepreneurial and venture capital mindset. And I think one of the fortunate things that we've had is actually the benefit of time, which is the gift of time has allowed us to continue to reiterate and learn from our experiences, but also to build a sustainable business through the larger group, and therefore provide a better and sustainable business. And if I was to lead one message for you guys to take away tonight, and I think this is it, which is the recent market reset has created one of the best and most important and compelling entry points that we've seen in the years. So ultimately, the decision that we all have to make is whether, we act now before the ship becomes the story that everyone tells, or not.